Peter Rose, Longwood Currency Trading. My trading framework. I have kind of a, and this is different than what I would teach or what I would do with a small account. What I do when I teach somebody and the things that I have done with the small accounts, or when I determine that I want to trade, downsize and trade a small account, those principles are easily ramped up into the higher account sizes. So I'm doing the same thing, I'm just doing it at perhaps a different time. Now, as you know, there are two major, actually there's three major types of trading. You have a long-term position trader, you're a day trader, or you can scalp. The difference between day trading, which I consider myself, and a scalper is that you will do many trades as a scalper on a daily basis, where a day trader is going to take 1 to maybe 5, but most likely you're going to limit yourself to 1 really good trade a day, maybe 3. If you have a lot of continuing volatility and you get out because of a stagger and you see the volatility is going to continue, then you could go in and take another one. It's going to be very rare that you're going to do that over more than 3 times. Okay, usually you're going to take 2 and that's going to be it for the day in order to be safe, because that third one that you take, you're going to get the timing on that wrong and it could cost you pretty much your whole day's work and you know, and maybe then some. So you have those 3 possibilities. Now, when I take somebody and I work with them on a consulting basis and they're starting out in their trading journey, or they don't have a good theoretical foundation in what they're doing, then we're going to do day trading. And we're going to do it on a single mini lot basis and learn the mechanics of trading to increase the win-to-loss ratio. I've said this many times, because that's really the key metric, or the key ability. It has nothing to do with being a metric, but it's your key ability at managing that entry of your position. Because if you can manage that correctly, if you can do correct entry analysis, that will give you a good win-to-loss ratio. Now, if you have a good win-to-loss ratio, but you're not making money because you can win 9 times in a row and lose once and wipe all that out, so you can still be a negative trader, the task then is to first get the win-to-loss ratio. That's number 1. Then the number 2 problem that we work on to solve is how to get the winning trades to be higher. And that's really a matter of how you judge what you might call the volatility of the particular price action at that time, or as I would call it, momentum, and it's a little bit different than price action. Nonetheless, as a day trader, once you get into the position management stage and the price is on its way to its profit target, I mean, as a day trader, you're not even going to want to make a trade unless it has 20 to 30 pips available to you, with a potential maybe there of 60. Because what's going to happen is that if that trade really starts to run, you're going to let it go to the profit target, and then you're going to have to be there and follow that very closely, so that if price does start to chatter just a little bit, boom, you get out. You may lose a little bit that you've built toward your profit target, but that's okay, because how often are you going to actually get to a 20 pip profit target? You're probably going to average, I mean, if I do the straight math and the statistics with it, I get 12 when I'm shooting for the 20. That's where I seem to average in, which gives me about 1.2% against per thousand against my risk, which is outstanding when I win. Now you got to balance that for the day by those trades that you lose. But regardless of that, when you get to the point where your win-to-loss ratio is indicative of not only a good win-to-loss ratio, but also a good average win value for the period that you're in. Then, when you get to the point where you are letting that single position run, then you can move into compounding and staging. But that's more of an intermediate or advanced level stuff that you get into, because it complicates things, and you're not going to do it on one mini lot. You're going to have at least 3 to 5 minis in order to do that staging. And trading mini lots, you really shouldn't be doing any staging. When you have a one full lot, you're still trading all in, all out. This is my philosophy, and that's how you transition from a 4-lot trader to a 5-lot trader. I mean, from a 4-figure account size to a 5-figure account size. When you start trading at $10,000, you're trading that one full lot for $10 a pip instead of $1 a pip. You're still not going to break that up into staging. You're not going to open with 3 minis and add 5 to them. You're not going to do that. It's just not advisable for you to do that. When you get to the point where you're trading that small 5-figure, one full lot amount, that's a huge step for you. But you have to continue to be cautious in your trading, and you're still doing all in, all out. Because if you can make the emotional transition and the little nuanced differences in moving from trading minis to trading a full lot, which, look, if you could make 15 pips a day, if you could make say 12 pips a day, like I could probably do, that's $120. You know, that's more than a lot of folks make a day. If you're on a, whoops, my cheat sheet here is flopping up in front of the screen. If you're working a $10 an hour job, and you work 8 hours, who works 8 hours at a $10 job? You're probably working 10 hours, but that's $100 a day at 10 bucks an hour. So to be able to make 12 pips on a full lot is $120, and you make that basically with no, well, it is, stop that. I have to have my cheat sheet because I'm going to be talking some numbers later, and I don't want to have to try to recall them. This is ridiculous. I should have probably taped that down, or I could just go inside and or turn away from the wind, which is swishing all around out here. We've had the last 4 or 5 days, we've had winds whipping through here at 20 miles an hour and up, and it's been in fact, the other day I came out and started doing a video, and you could just start to hear the wind in there, so I went inside and worked in there. In any event, if you can average that 12 pips on a full lot, that's $120. Now you're making a day's wage of a $10 an hour worker. And so that's a good position to have yourself in with that one full lot. If you start staging that and you're not really confident in your trading and have established a good process, which you're going to need 300 trades over trading the minis and then starting to trade this one full lot before you consider increasing the size of your trading bank so that you can go to 2 or 10 fulls or whatever it is that you're going to take the next step to. My advice has always been for folks to, if you have the resources behind you, to go from a $10,000 account to a $30,000. That's a nice jump in the trading spectrum. You don't do that trading minis. You don't go from trading 1 mini to trading 3 minis, because now you're not trading for pips and knowledge. You're starting to trade for money, and the last thing you want to be doing is trading for money when you're trading small and learning. You have to get out of that habit. But this is the way I teach. I haven't had many students because they don't have the patience to learn my way. And look, I've been teaching martial arts for over 50 years, and it's my way, and this is the way you got to do it, and it's successful. And if you don't want to do it that way, this is my house, get out. And so I'm not a real good hand holder for little babies who want to run their little $1,000 or $3,000 mini account to $12,000. That's not the purpose of trading at a small lot level. And you do not have the experience to take a small account and build it, to take a $1,000 account and build that to $10,000 in a year. You don't have that skill. Otherwise, if you did have the skill, you'd be trading, a $50,000 account. But, you got to be realistic about what's going on. This discussion is about the use of the knowledge that you gain trading those. I'm holding on to this cheat sheet. By trading for pips at the lower level, and then moving those skills up into trading multiple full lots. And so my framework for teaching students is this all in, all out, nothing fancy, no compounding process until you get to the point where you can trade enough money to replace your job income. And trading a $10,000 account is not going to replace your job income, even though I just said, well, 12 pips on a $10,000 account, $120, and that's more than the daily wage of most workers. And even though that's true, you're not going to be able to make that 12 pips a day. I was able to make the 12 pips a day because I had the experience. I took the time trading the small accounts. Look, when I started trading a live account, I lost $40,000 because that's what I trained in. I didn't have anybody to tell me anything different. And I think that's why a lot of folks fail at trading. You do well in your little simulated account, as I did. You do okay trading the little lots, and you're anxious to make the big money, and you know that if you throw more wood on the fire, you get a hotter fire. And so you go and you take as much money as you can and you start trading it, but you really don't know what you're doing. I took that $40,000 and I lost it. I was left with $5,000 in my account. I stepped back from it. What's going on here? It can't be this complicated. This is stupid. I've made this far more complicated by listening to these guys that are out there teaching this stuff. They don't know how to teach. I'm a teacher. I understand the educational process because I teach one of the most important skills that you can have, and that's self-defense and survival. I kind of get the importance of being able to break down into root elements the skill sets that you need to have and how to practice those skill sets. And so if you follow the process through, you're a day trader and you're all in, all out until you get to that $30,000 level. And then you're so bored and it's so easy for you to all in, all out on a $10,000 account to make $120 a day, and you're making $120. Well, at that point, why don't you make $360 a day or $500 a day? Because all you got to do is up your bank and you up the amount of money. You don't increase the number of pips that you look for. That's the key to my framework, is not to increase the number of pips that you're working for, because that pip value that you start back when you're a one lot trader or you're learning on the mini lots, that establishes your win to loss ratio. If you do it the right way, the win to loss ratio, you'll always have that, and you'll be able to improve it with your skill, not because you're going to trade more lots. More pips. Expect more pips from your trades. As soon as you change the number of pips that you're trying to achieve in your entry process, you will go broke. Because, this isn't a video about that. Let's just go back and say that the objective of what I'm trying to do here in this video, swing around here now, the wind has changed, and it's a prettier view of Sue's Gardens. They're all just starting to come up now. This is mid-July of 2022, so it's time for that, all that stuff to start to come to fruition and blossom. So my framework is based on all three of those methodologies: scalping, day trading, and long-term position trading. And here's how I glue them all together. My intent is to start out as a day trader, trading 1 to at most 3 times a day, and to make a minimum of 0.5% on my risk a day. That's all I'm trying to do. So in other words, I'm making $5 1,000 on my trading. That's all I'm looking for. Because when you trade a 6-figure account where I'm at now, even just the raw $100,000, 0.5% is $500. So even though you're only trading for the same pip value, trying to make sure you end up there. I mean, I'm trying to get 20 pips, and that's why I'm saying I'm generally able to average at about 12 pips, but I want to end each day at least 0.5%, because if that's all I'm capable of doing, maybe because market conditions or you get sick and you take a few days off and whatever, if the average is all out, you've made $500 a day, 5 days a week. You've made $2,500 a week times 40 weeks, let's say. I mean, you're making really good money. Even if you trade $100,000 account, if you can make $40,000 on that, that's 40%. I mean, you know, come on, what do you want? 400% return? It's the gradual increasing that provides you that ability to be consistent. And then when you get up to the point where I've got trades running right now that I'm trading at $200 a pip. You know, I make 1 pip, I make more than 60% of the working population. 1 pip, I make $200. So now the dollars are magnified, but the number of pips that you try for has not. So that work that I put in is no less or no more than it was originally. So the goal there is to be a day trader and to be flat at the end of the day. That defines a day trader. You're flat at the end of the day. I bring in to my framework the fact that what happens if I'm at the end of the day, and by the way, I don't get out at the profit target. I'm there watching that profit target, and once it goes past the profit target, I start trailing a stop behind that, very, very close. Probably 5 pips or some percentage to the current price, because I don't want to lose any of that ground, because that ground comes up very infrequently. And usually when price takes off and goes beyond your profit target, you're in a high momentum, high velocity period. And what do you know from your experience in trading? At some point, if you're getting 5-minute candles, which have an ATR of about 5 pips on most of the majors, and all of a sudden you've got 15 pip candles, and you stack 3 or 4 of those on top of each other, now you're I don't know, you're 15 times 3, you're 50 pips up into this trade, and by now you're staging into the trade. So you might have started with 3 lots, and then you've added another 3, and then add another 3, and then you start adding singles to keep your average price low, so that you've got some wiggle room there when the price, if it snaps down back against you. And then at some point, after 3 or 4 of those 5-minute, 15 pip moves, you're going to have a retracement. And those retracements generally are about half of that exaggerated distance. So you're talking about that particular price run probably went from the initiation of where you started that trade. It's probably run now 60 pips. So that retracement's going to be 30. So knowing that, and there are certain reasons for that, knowing that, why would I want to set my stop 10 pips below that? Because I'm going to lose the 10 pips. Because it's coming back 30. So I'll set it a small percentage behind wherever that current price is, and it snaps down and it takes me out, and that's fine. If it turns around and continues to go up, I just judge that as a brand new entry opportunity, and then I can go in. But I go in lighter than I did in my original trade because the probability of that snapping back against me is very long, and then I may go into the one of two things. One, if I'm at the end of the day and that price is still moving up, why would I close it out? I'll go to a carry trade, and now I'm using the theories that are applicable for a long-term position trader, and that changes the way that you trade. Not so much the way that you trade, but when you do certain things, because the when is different for a position trader than it is for a day trader, and it's definitely different than for a scalper. Let's say I'm not at the end of the day, that I'm in this trade, it's 60 pips, it's gone 60 pips, and it's still going. I saw some chatter and I got out. All right, I've got my money, it came back 8 or 10 pips or whatever, 15, and now it's gone back up and it crosses where I had exited before. So that means there's a good chance it's going to continue on. How far is it going to continue on? It could go 50% of, or it could go the same distance that it just retraced. So now I'll go back in, but I'll go back in lighter than I did for my original opening trade. So if I went in 3 full lots to that day trade and then staged in and bumped out, and now I'm in a new trade, but because this is a continuation of an existing momentum, I'm only going in with 1 lot. And then I'm going to scalp that 1 lot. And scalping means you trade small, but you trade a lot. So every time that movement goes up, the probability increases that it's going to go down. And so it goes up, and I got 3 solid pips. It gets to 5. It starts to chatter a little bit on the 5-second chart. Boom, I'm out. So I make 3 pips or 4 pips. If the price goes back up and clears that spot where I got out, I go back in with 1, and it goes up and it hits 5, and then it starts to chatter and it comes down, boom, and I'm out. If I don't catch it in time and it comes down and I'm slow at getting out, that's fine, because it basically cancels the 3 pips that I made in the previous trade. When you learn scalping and you're learning trade small, trade a lot, your win to loss ratio has to be very high because of the number of times you're going to have to take those losses. For example, if you're a 70-30 win-loss trader, you're not going to be scalping. And the reason for that is, let's say that you're scalping for 5 pips, and you're gonna be willing to take an 8 pip loss. Well, that's what I would take as a day trader. But scalping to me is no different, because if I've got a 70-30 win to loss, let's see what that looks like. So 7 times I'm going to win 5 pips. That's 35 pips. And 3 times I'm going to lose 8 pips. That's 24 pips. That's 11 pips. That's 0.1% per 1,000 over the 10 trades a day, because you're going to make 10 trades a day. So you're making 0.1%. That's you trade 20 days a month. You make 2.2% per month. And look, you trade 10 months. That's 20% on your money. So you can't slouch at that. But what if you were an 85% winner, 15% loser? You know, basically 80%, 85%. Let's do the same numbers. 8.5 trades, you're going to make 5 pips, 42.50, and 1.5 times you're going to lose 8 pips. That's 12 total pips. You've made 30 pips over the 10 trades. That's 3 pips a day. That's 3/10 per thousand on your money, 6% a month. Now you're at 60% on your risk a year. So just by, you see that, and that gives you plenty of runway then for making mistakes, and maybe dropping that to 40% or something if you get caught really bad sometime, or you get greedy, or whatever it is that's going to happen, or the market changes a little bit on you and you have to adjust some of your strategies. So those are the statistics that you use if you're looking at scalping. You better have at least an 80-20 win to loss, because you're going to be in and out of there so many times. You really need to pick that up. I think if I did the 3 pip, 3 pips times 7 would be 21, and 8 would be 24. So you'd be a loser if all you did on the 70-30 trader was get 5 pips. So that's why I don't advocate that you go into scalping unless you can scalp at an 80-20 win to loss. That doesn't mean you can't trade unless you're an 80-20 trader, because you can be successful minimally at 60-40. And I've done the math to show this. In fact, most of the examples that I do in my courses are done as a 60-40 trader, because that's about as good as you need to be in order to justify going up and trading one full lot at a $10,000 account. If you're not running 60-40, you better not be trading Forex with the $10,000, because you're going to run into problems with that. So my framework then is a combination of all 3 methodologies done at different times. And there's the characteristic secret sauce that you have to be taught. You can't hear me talk about it. In trading, there's three questions that need to be answered in your education. What do you do? How do you do it? And when do you do it? Those are the 3. Let me rip this thing off. I don't need this anymore. When do you do those things? We've got 3 phases in the life cycle of a currency position. You have your entry analysis, you have your position management, and you have your exit methodology. Each one of those phases says, what do you do during this phase? How do you do it? And when do you do it? And with each one of those phases contains a strategy. And the strategy contains between 3 and 5 rules in order to satisfy that strategy under different conditions. So overall, if you have 3 rules per strategy, you've got 15 rules overall for the entire strategy methodology that I have. That's not very many, considering that if you pick one rule up here to do something, it eliminates maybe 1 or 2 or 3 or 4 of the other following rules in the other systems. A lot like a chess game. You know, you pick a certain opening pattern, you automatically eliminate 80% of the moves that you could make, because it's not consistent with playing that particular opening pattern. But this is all stuff that's based on probability, which I'm pretty good at because I've got a bachelor's degree in physics. I went to grad school for a little while in it, so I got almost a minor in math. I was a real estate investor for 40 years. During that period, I lost $1 million twice of net worth, all the way to my base assets. I never lost my assets, but I lost $1 million net worth twice. I made that $1 million back each time, but it took me 10 years each time, and enabled me to to retire, paying cash for this house and putting another $40,000 into renovation into it before I even sold my other house to move in. So I'm very familiar and very knowledgeable about probabilities. And that isn't to say that you need to do the mathematics of the probabilities and you need to know statistics and all that other kind of shit, or take courses in it, or take a, there's a book out there, all you need to know about probability and statistics. No, you don't need to do that, because all of the stuff that I do is based on how a physicist would look at it, and that's what's the background noise. Let's get rid of the background noise and let's just focus on what the solution is. I was watching a video just the other day on a lecture of a guy who was talking about developing the Lagrangian equations for problems in mechanics and physics. And in undergraduate physics, you use Newtonian mathematics and considerations, basically F equals ma. In Lagrangian, it's really complicated with second order differential equations and all this other kind of crap, and it's generic across the board for coordinate systems that your system exists within. However, what the physicist does when they get to the point where they're teaching this Lagrangian mathematics, or Lagrange's equation, the Euler-Lagrange equation, is they throw out all the stuff that they don't need to know or to be concerned with. And in fact, you don't have to know anything in your head other than the concepts of calculus and the difference between a first order and a second order differential equation, and in fact you don't even need to know a second order differential equation, but working on full derivatives and partial derivatives, how you do that. As long as you have a basic understanding of that, you can understand how the Lagrangian mathematics was created to solve more complex problems. And it's that way in trading. The use of, and that's how I built my framework, not only for myself, but also I had to do what I teach beginning students to do, because that's the basic nuts and bolts that you need to learn, so that when you get to the point where you're ready, in my opinion, to compound or to stage in, stage out, average in, average out, it's easy for you, because you understand the background, right? If you don't understand the background principles of soccer, and you get out on the field, you can know all the rules of the game, but if you don't understand the principle, what you're trying to do with the ball, and what some of the basic rules are, you're not gonna get to be a paid league team player. It's just not going to happen. And that's why the framework that I present is presented under the three phases of the life cycle of a currency pair, focusing on the entry analysis first, position management, and exit methodology as it relates to trading all in, all out, one mini lot, to build up a good win-to-loss ratio. And then taking the next step, which would be to make sure your average win value is good, so that you're not winning 9 times and then your one loss blows it all away. And trade that one mini lot under principles. I won't allow you to trade 2. I won't allow you to trade 3, because then you're trading for money instead of for pips. You're going to go from one mini to one full lot. Oh, I don't have that. $2,000 is all I can come up with. Then what the fuck are you doing in currency trading? Because you're just going to lose the $500 that you have. You're not going to be able to learn this stuff the right way. You're trading more under fear and greed and want for money than you are in wanting to learn the principles. Would you like to go to a neurosurgeon who only wanted to do neurosurgery because he wanted to crack a skull and get in and see the brain and how it all worked. He didn't want to go through the 8 years of training that it took him to be a neurosurgeon just because he thought by looking at the brain he could fix it. Is that what you would want to place your life in the hands of? I can't believe the number of people that I talk to that believe the horseshit that these folks out there are teaching. You know, when I first got into real estate in the early 1970s, I went to the guys that were doing real estate, and I read the books that were out there. And if they said, you need to do this in this order, I did that because that's the way you needed to do it. That's what made them successful. And that's the way that you do it. There isn't any shortcut. There isn't any other different way to do it. That's why real estate is simple to make money if you understand what those principles are. Again, if you go off and listen to the guys, the no money down guys, and all this other shit, you'll end up like a friend of mine who didn't know any. He knew a lot about business, but he didn't know anything about real estate. And when the cracker came, he sold his business, took all his money, and started buying all this real estate, high leverage stuff, because he was buying multitudes of property because he had the money to do that. And when the crack came, the banks came to him and said, look, the value of your property is below the market value. We want you to make up that difference. Well, I don't have the $100,000 right now in cash. It's all in property. Fine. Well, we're going to foreclose on you. He lost all his properties, and there were quite a few of them. He lost his Jaguar. He had an expensive boat. He lost his family, his home. He lost everything, because he didn't do it the right way. Be realistic. That's the first thing you have to do, is be realistic. That doesn't mean, oh, you're going to be hampered forever with this one mini lot and there's no way you're ever going to make enough money. I can show you how you can get another $10,000 to add to that account and not do it through trading. Because there's just such a shithouse full of money circulating out there, and the money that happens to splash on us, we piss away so much. I just took my wife out to dinner last night. We spent $120 for dinner and wine and a good time. 3 nights or 4 nights ago, we went out to dinner again, and I spent it was about $180 for dinner. For absolutely no reason. Well, there were some celebration reasons. The dinner four nights ago was to celebrate the largest monthly gain that I've ever had. That was $30,000 in that month. And the dinner we went out to last night was to celebrate the largest closed trade loss that I've ever had. And at the time I did the video, I had said that I had woken up and it was 15,000 against me, and I was just going to let it run for a while. And there'll be a follow-up video to that to show you how all that happened if I haven't already posted that video. But because we celebrate the good, and you got to celebrate the bad as well. But because there's so much money that sloshes off us that doesn't have to, I can show you how to make that money stick. Because when I started in 1973 buying real estate, well, 74, I guess. But in 1973, I guess I want to tell you, I left graduate school, and the only skill I had was martial arts. I was a second-degree black belt in karate at that time, and it was martial arts. I opened a karate school, so that's what I did. I opened a karate school, and I was making money to support myself. And I was living in Portsmouth, New Hampshire, which even then was expensive for its time, but it was manageable because I knew how to manage my money. But I was turned down for a gas credit card because my income wasn't high enough. But what I was doing was saving 20% of my money and breaking that up into different savings buckets. And that money that I had saved was about $3,500 was the down payment, along with a lot of other scraping that I had to do, was the down payment on my first piece of real estate. And because when I opened the karate school, my net worth was $1,200. I took $3,500 from my successful business, bought my first piece of real estate, and that grew to the point where, again, I said I've lost $1 million net worth twice and was able to make that back. So from that initial seed money, well, where did the other money come from? Did it come from the appreciation of the properties to buy the next property? No, it didn't, because I didn't sell the properties. That's not what you do. If you want to be a flipper, you can be a flipper, and you can be quite successful at it. I just happen to know the rules of the game, the way they are played for life, not for time frames. You buy and you hold it. So the money, the extra money that came for me to buy the next property came from money that I made. And if I didn't make that extra money to have the down payment, I couldn't buy the property. So again, I constantly had those good habits in order to get that money so that I could buy that next property. And that's what I can show you how to do if you're sitting there whining and complaining that you only have $2,000 and that's a lot of money for you. Look, if you got the $2,000 and it's that hard for you to do that, man, you don't want to lose that $2,000. And so it's important to learn how to build these trading frameworks so that you're learning the skills the right way for the right purposes, so that as you learn how to accumulate money from other sources than you're trading, you add that into your account, and that account then grows. And as that account grows, you don't take any money out of it. You let that account grow and you add money to it. It's like a flower. You put the flower in and then you add water and you add nutrients. You don't take that out. You add to it. And it grows and it grows and it grows. And all of a sudden, the money that it's throwing off will replace your job income. And then it'll get to a point where you'll build wealth with the money. If you're working a $40,000 a year job, and I'm talking about United States, I understand some of you guys out there are working for $15,000 to $20,000 a year and you're doing just fine in the countries that you're in. I can only express this in terms of what is available to us here in the United States in terms of dollars. You just have to translate that to the same thing in your own country. That's all. It becomes really simple. Because I only teach by numbers. I don't teach by value. We're not teaching by dollars. We're teaching by pips. One pip is one pip, whether it's a pip in the United States or it's a pip for you in Pakistan or Istanbul or some of the folks I've talked with in Africa or Ireland, wherever. A pip's a pip. It might translate into different value for you in your currency, but in the U.S., one mini lot, $1,000, it's $1 a point. And I say $1,000 because you need margin in order to get in there to do that. Those are all the characteristics that are the foundations of this framework that I'm talking to you about as to how I trade and how I combine the three different methodologies of trading with either a day trade, the basic flat at the end of the day, whether that's going to bleed off into a long-term position trade. Long-term, for me, would be carry over 2 or 3 days. I've carried trades for 3 months because you don't know. But the strategy is the same, but the numbers just change. Your risk changes, your view of your profit target changes. All that changes once you slip off into a carry trade. And whether you're going to carry for a day and be out the next day, or you're going to carry for 3 months, doesn't make any difference. The rules don't change for that. So whether you're a day trader and you're going to slip into a long-term position trade, close it out as a day trade, or you're going to take that day trade and slip into a scalping mode, which again is a flat at the end of the day. You have to be able to blend all three of those together in order to do what I do. But you can't do that where you are because you don't have the skill to do that. Find somebody that will allow you to learn those skills in the order in which it's necessary to learn them. If you are going to be an auto mechanic, are you going to learn how to replace a car's pistons before you do the basic learning about an exhaust system and you know, all those ancillary systems that are around it before you go doing major stuff? Well, yeah, you're going to read the manual and you can tear the engine apart. Look, I had a motorcycle one time. You're tearing your motorcycle apart more times than it's on the road. I've changed pistons and all that kind of shit. I've pulled heads and had them ground down and had them repositioned. But I didn't just jump into that with absolutely no knowledge of anything. On a motorcycle, it's kind of easy. I can remember one time driving along on a motorcycle, and I looked down and my boot was all black. And I pulled over and it was oil. Where the hell did that come from? It came from the generator had fallen out or something. I don't know what it was, and banged something. Anyway, I learned that there were some bolts and nuts that I wasn't tightening down before I got on my scooter every day to go out to ride. Because you have to lock everything down before you get on that bike and ride. I didn't know. I missed that. So I learned that. I learned those little pieces, and then one day I pulled into my friend's, and he goes, "Boy, that really sounds like you've blown a gasket in your piston. You blew a piston ring." So what does that mean? And he explained it, and he said, I said, "Well, I got to bring it in and fix it." He goes, "Why?" "And fix it yourself." I said, "I don't know how to do that." Right? He said, "Well, here's the manual. What have you done before?" He goes, "Oh, okay. Well, you're probably ready to do that. Go ahead, try it." I did it. In fact, in my short career of motorcycles, I had to do that 3 times. If you want a long career in trading, you need to make sure that you know those really basic steps, because those are the foundations of everything that you're going to do. And if they're good basic steps, they will be repeated just in a different form or in a different time when you're doing all this other supposedly complicated stuff, which isn't complicated as long as you understand the basic stuff. It only becomes complicated if you don't understand the basic stuff. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.